Okay, quick sound check. 1, 2, 3. Welcome back, everyone. Just a quick sound check, and then we can get started. Okay, so, audio seems to be good on my side. I hope you guys had a great week, and we can get started with Trading Psychology Part 2. My name is Vito and Henjoto. So we did talk a little bit about pattern recognitions and stuff like that last week. In particular, what kind of patterns are we looking for when it comes to our trading? So that's the kind of stuff that we are actually going to be going through tonight. Okay, so welcome to Trading Psychology number 2. But before we begin, just a quick general advice and risk warning disclaimer. Note that any advice given is deemed to be of general nature, as the information or advice given does not take into account your particular objectives, financial situations, or needs. Therefore, at all times, you should consider the appropriateness of the advice before you act further. We do not offer single service, managed funds, or other personalized advisory services. Please be aware of scams that promise guaranteed returns or managed accounts. CFDs and Forex are leveraged products that carry a high level of risk and are not suitable for everyone. You can lose more than your initial deposit, so you should ensure CFD and Forex trading meets your investment objectives. Strategies and charts used in this presentation are for example only. You are reminded that past performance is not indicative of future performance. All right, good. Happy to have you guys here with me again on Friday. Thanks for giving me your Fridays, which is really awesome. Okay. So, doesn't seem like a lot in there, right? So we'll try to keep it to that 1 hour time frame. I know we went a little bit over time last week. We did an hour and a half. But tonight we are basically going to talk about pattern recognition. What is that pattern recognition that we are referring to? I'm referring to, and then we'll talk a little bit about trading journal. And then what is your best learning environment, or BLEs, psychology of risk management, and a little bit on trauma recovery methodology. But we'll touch base on those, a little bit about, it's called psychology of risk management, and then what happens if you really blow up your account and stuff like that. And it happens, you sometimes get a series of losses, and that's part of trading. So it's not always the good things. People only talk about the good things. I'm probably going to talk more about the bad things. Okay, so this is in continuation to last week's session. We did talk a little bit about pattern recognition. So we do know that pattern recognition can be seen in both technical and fundamental analysis. Just to recap to some of you guys, maybe you guys are new. So what are we talking about? What is those patterns in technical and fundamentals? So example of technical patterns, we take a look at candlestick patterns. All right, they are a completely different study to price patterns. And then we have chart patterns. Those are basically the three main studies that people actually look at. But there's obviously a lot more, because we can take a look at momentum patterns, oscillator patterns, moving averages patterns, right? Fibonacci patterns, Ichimoku patterns. There's a lot of patterns in there. But patterns are basically part of your trading. And that's basically how traders look at the market. We try and identify patterns to, kind of figure out what's likely going to happen in the future, right? So example of fundamental patterns, price reaction to interest rate changes, price reaction to inflation or employment numbers or jobs data. So, for example, with the CPI numbers, sometimes we look at the CPI numbers and we put priority on whether or not it's actually time for the NFP number or the employment number to take center stage, or is it going to be the CPI numbers in a month. And then if you take a look at the movement of the major currencies in the past 4 months, you can take a look at the CPI numbers, how big of an impact it is. So just from previous months, there are patterns that develop. There are specific ranges that we can take a look at. So those are example of fundamental patterns. So not a lot of people actually understand what is fundamental patterns, but don't worry about that. I gave out my outlook every week, and we touch base on fundamentals. Okay, so if there's any patterns to watch out for, then I'll be sure to notify you. But the pattern that I want to talk about tonight, it's not going to be the technical or the fundamental patterns, but it's your pattern, right? It's your trading pattern, which is going to be unique and different from the others. I'm good, Sajid. How are you? Well, if you have any questions, stop me. Type it in, and I'll go through that. I'm looking at the chat at the same time as well. Okay, so no one, that's basically there's never gonna be another trader that's going to act or think or have the same rational thinking like yourself. I think when we talk about psychology, we talk about how unique everyone is, and that's basically it. When it comes to trading, I can impart some of my knowledge to you. You can try and match it with how you trade, but we'll never be identical, right? We could be using the same things, we could be looking at the same things, but we have a different train of thoughts. We have different risk appetite, right? We maybe I'm more risk averse. I don't really want to risk too much in the market. Maybe your risk profile is a little bit higher. You take a little bit more risk. Even with the same thing, even if we were looking at the same time frame, both of us are swing traders. We might have a different view on what we think about the market. Okay. All right, but the patterns that we want to take a look at is actually your trading hours. It's easy for some marketing, I guess. It's easy for someone to say and kind of entice you that, hey, you know what, trading is easy. You can trade 24/7. No one in their right mind is going to be doing that. No one is going to be trading 24/7. Remember that in the first place, when you jump into trading and investing, the purpose to a lot of you is basically how to get an income that you can actually match or adjust to your particular lifestyle or time, right? So you need to look at those trading hours as well. If you are trading and you feel the need to wake up in the middle of the night, you are forced to wake up in the middle of the night, and to trade something, that's not really trading. That's not trading. So I think what I see with a lot of people, about maybe 90% of traders that are new and just started their journey, this is a problem because you're not really making trading or investing work for you. Instead, it's the other way around. You need to be kind of a slave to them, right? Or enslave, I guess that's the word, right? So don't feel enslaved to trading. I don't think there's a need to wake up in the middle of the night and do a particular trade, just because you feel forced to, right? So I think when it comes to your psychology, because I think I noted someone saying like, hey, pretty depressed for the past year. What was it gonna do? I think when you are in that kind of situation, I think you need to pull back a little bit and then take a look at your current mental psyche. Is this something for you? Because this might not be for you, right? But if you are trading and you find it really hard, I think number one is you need to identify your trading hours. All right, it can be morning, afternoon, evening. It can be the combination of both. I do morning and afternoon. I don't do evening tradings, right? Evening trading is my own time. It's time for me to wind down. But yeah, that's basically how I trade, right? So don't feel forced. All right, that's number one. That's your trading hours. You kind of, I'm not gonna be able to tell you what time you should be trading, because it really depends on your traded instruments. Right, so after you identify what time you need to be trading, or how about this? Instead of using the word need, how about we change it to want? All right, what time do you want to trade? I think that works better because you decide what time you want to trade, and then you can take a look at some of the traded instruments that matches what time you trade, right? What time you want to trade. That's two things, right? So the reason why I talk about traded instruments is because certain currencies doesn't really move at all during a certain period of time. So we really need to know what's going on there. There are specific dead zones between time zones, right? For example, the busiest time of the day is basically when the Japanese market crosses over with the European market, right? I think that's busy for currency. And then it goes quiet for about 2 hours or three. All right, waiting for the American market to start. All right, so there are actually times for you to avoid, and I think this was brought up last Wednesday. Someone actually asked me, do I actually execute some of the trades and stuff like that? It's either before the webinar happens or after the webinar happens, because the reason why I choose the time for the webinar is because that's when the dead zone is. The market is kind of a little bit flat. All right. All right, number 3 is going to be your trading methods and what kind of trader you are. So I'm lumping trading methods and what type of trader you are in the same bullet point, because trading methodology, it's basically what defines you as the kind of traders you are, or it's the other way around. Depending on what kind of traders you are going to be looking at a specific trading methods. All right, so this 3 points, it's basically the pattern that you need to identify. I'm not going to be able to identify that for you. I can give you a guideline on how you can identify this yourself. But number 1, you need to know when do you want to trade. Number 2, what do you want to trade? And number 3, how do you want to trade, right? So I don't there's the 4 W's. Sorry, there's the 4 questions, right? So it's when, what, how. I'm not going to ask you why, because why is basically what get you in here. So this is the remaining questions. When do you want to trade it? What do you want to trade it? And how are you going to trade it? All right. So that's basically the stuff, right? That you need to understand. Because if you don't want to admit whatever I'm talking about on this slide, there's going to be a problem. It's going to be hard for you to actually change the way you look at the market, because just tweaking a little bit on how you look at the market could really go a long way. It's like we set our own rules, which are best practice for us, and follow it every day to achieve competence. It applies to all aspects of life. Yeah, it's pretty much that, right? Maybe you wake up in the morning. The question is, why do you wake up in the morning? Because it's morning, because the sun gets up, right? Maybe some people don't wake up in the morning. Some people actually sleep in the morning and wake up in the evening. It's you're not Dracula or anything like that, but your body clock. Everyone's body clock is going to be different, right? Maybe 3 hours of sleep every day is good for you. It might not be enough for a lot of people. So again, I think what Mudasar is saying is it's pretty much it. You set your own rules, what's best for you, and then you're gonna follow it. Simple as that. After watching the webinars, I've got a perspective on trading. I'm trading it for the past 10 years, but without direction. Oh, that's awesome, man. That's really great. I like that comment. Thanks, Mudassar. Now I'm happy to be of help, and I think that's probably the reason why people are watching this right now, because they do want to know, well, what's kind of the other side of what are the other factors that's going to affect you. And I say this last week. 80% is going to be how you view the market. 80% is how you're going to treat yourself. 80% is basically the way you think about the market, which is your trading psychology. All right. So how do we start achieving this? I think I mentioned this briefly last week, but good traders don't get successful because they know how to view the market. It's because they know how to review their trades, right? So it's always review and replay your trades to learn your winning patterns as well as your losing patterns. So this is the other side of things that you need to look at. And last week I gave you the analogy about going to the gym, but it's being a sportsman, but take it to sports professionals, right? I don't know about you. I don't play golf, right? Some of my friends do, and all they do when they talk about golf, it's basically just showing the other players, oh, this is how I don't even know how do you call it, your shot maybe. This is how I hit it. This is how I hit the ball. This is how I swing it, right? That's the kind of stuff they talk about. So it's the same thing with playing tennis, right? I play tennis, so I can probably talk more about that. We watch tennis matches, right? And we look at how they tackle a certain problem. If the ball goes this way, what's the best move and stuff like that. Professional traders improve themselves by recording what they do. So, you kind of need to have a record of some sort. So, yeah, otherwise you're not going to be able to improve your performance. It's as simple as that. It's just simple logic, right? If you do something, you basically need to know if you're doing it right. Okay, if you don't know if you're doing it right, you get someone to take that. You get someone that knows how to do it right, and then ask them. Am I doing the right thing? That's the same thing. The problem with a lot of traders is that they don't really want to discuss their losses, and even if they're losing, they'll meet up their friends, and if their friends ask them how's your trading, or if they meet up with other traders, how's your trading, how's your trading going, and then everyone's just gonna say, oh yeah, it's great, I've been very, very successful, I'm doing great. But they don't really talk about whether or not they're really doing great. So that's always there, right? It's probably the ego part when it comes to being labeled as a trader. But people will probably tell you, you kind of need to take a look at why you went wrong or what went wrong. I'm more focused on analyzing winning trades, right? And I really want to know how I got it right, because that's how I'm going to improve myself, right? How did I get it right? What happened, right? So I'll need to do that as soon as possible if there's a winning trade that goes smoothly, quickly, and accurately. So we are going to talk about trading plans in a separate webinar, trading strategies in a separate webinar. But if you follow a certain plan and everything went right, you basically want to know as soon as possible, how did you achieve it? What is there? What factor plays in that makes your analysis correct, for example, or what makes your trade goes in the right direction? Same thing with losing trades, right? You need to do that as soon as possible if you feel there's something strange from your expectations in the market. So, for example, if I think this was actually us. Was it last week? Let me just check the calendar. Yeah, it was last Thursday. So we have the UK CPI numbers. That was good, right? A lot of people just assume because the UK CPI is good, they should go long on sterling. It doesn't go that way, but it's not why it doesn't go that way. Instead of blaming others, you need to figure out as soon as possible what other factors was in play that kind of throw your game away, right? Because we have the US CPI numbers. If that goes up, the US dollar typically goes up, and you apply the same view, the same pattern to the sterling, and it doesn't work that way. Why? What happened? Obviously, there are other factors which I'm not going to repeat here, but you need to identify what is it that causes you to actually lose out on that trade, what actually went wrong, right? So if you're losing trade, losing trades may actually occur due to factors that are not included in the trade risk calculation, which is stuff we haven't touched on. But if you guys jump in onto my webinar, the first thing, and this is the same thing I said last week, was I don't care about what are my potential gains. I care more about what are my potential risks, right? So I calculate my risks first, and then I jump in on a trade. If I calculated my risks and the trade goes against me, I really need to know what other factors are actually in play that causes my technical to go wrong, or something like that, right? And the last point here is basically you need to think and accept your mistakes and immediately find out the point of the problem, and also what will be the solution for the future. So we really, when it comes to trading psychology, it's really more about acceptance, because it's not an easy thing to admit that you're not doing great in trading. So at that point in your trading career, either you have the determination to improve on your trading, or you give up. That's basically it, right? If you started trading, you jump in on this webinar and I'll tell you all this stuff, you guys probably don't get it. But if you have been trading and things doesn't go as smoothly as you think it should be, then you might understand what I'm trying to get to right now. It's just that it's very hard to accept mistakes when it comes to trading, and a lot of people look at their losing trades and really focus on their losing trades. They don't really focus on their winning trades, but it's actually both that you need to know. You need to know what you're doing right, what you're doing wrong. Okay, so this stuff is your pattern recognition, because the sooner that you do it, and if you have a record on hand, when I trade, I'll always have a notebook and a pen. I'll do quick notes when I trade. That's basically that, and then I put it in onto my trading journal, the reason why I traded and stuff like that. But you need something to record it, which we'll talk about later. Okay, so pattern recognition speed is very important. You need to identify what went right and what went wrong as soon as possible. And also, when we talk about pattern recognition here, it also applies to technical patterns, fundamental patterns. We need to absorb that information as quickly as possible, and then, figure out how to fix it going forward in the future. So speed is really important, right? That's number one. The sooner that you can process the information, but don't look, if you're new to processing this kind of patterns, don't rush into it. I would say speed is important, obviously, because we need the speed to react to changes in the market as soon as possible. But to get there, I think you need to take your time a little bit. Just be slow, but really look into it, and over time you are going to speed up, right? And the key to that is actually repetition in the market. The more we trade, the faster we recognize our own trading patterns or technical patterns that we often experience, and there's no other way around it. It's not that I can give you a webinar and then you're going to get it, because I'll tell you, you're not going to get it, because you need to repeat the same thing over and over again. The more we repeat the trades that we make, the faster we will actually recognize those patterns that will actually occur in the market. And also these patterns, it's not also the patterns from the way we trade individually is obviously going to be key, because how I trade, for example, I can give you an example on how I actually trade, and how I actually have enough time to actually look in the market. You guys probably know that my job, it's basically I'm an analyst, but I also trade, right? But when I work for a firm, my job is as a market strategist. It's more on research, okay? So I need to look at a lot of stuff in the morning. Basically throughout the day, I need to process those information as quickly as I can and somehow translate it back to the clients, which is that's obviously not easy. All right, I need to gather as much information as I can and then relay that message again so that it's still going to be useful for a lot of people. So if you think I have it easy, I don't have it easy. It's hard, all right? And also, I've been in the market for 20 years, and I'm repeating the same thing over and over again, to the point I actually don't even need some of the tools that we use to look at the market. For example, when I'm in a rush, or if I look at things quickly, I don't even need to draw Fibonacci retracement to figure out where price is. It's quite easy for me to actually pick out where price is roughly. But that's basically it. And for you to get to that level, can you do it quick? Yeah. I mean, for example, for in the next month, for example, you keep looking at Fibonacci, just Fibonacci every day, you are going to build up the that speed, right? If you do it a month, you're going to speed up from the beginning of the month. You do the same thing over and over again for the second month. You're just going to speed up. That's as simple as that. So it's not really about understanding everything in the market. I don't need you to understand everything in the market. I have new materials every week, obviously, because some people like this, some people don't like that, some people are still learning. But once you go out there and you really go out there, my tips for you is that you don't need to understand everything, but you need to understand a few things and repeat them over and over again. That's how you build up your experience. That's how you build up the speed when it comes to understanding stuff in the market. How quickly can you absorb information? For example, like the FOMC meeting minutes. FOMC meeting minutes. When was the FOMC meeting? Totally forgot. It was just about Wednesday, right? Wednesday, jumbled up. So the FOMC meeting minutes was out Wednesday, and it was in the middle of the night for me. I think it was around 2 a.m. And then I posted out this information, I believe, on the Telegram channel about 2:30, right? I gave out some of the information early, and then obviously the next day we processed it a little bit more. But how do I actually go through the whole minutes as quickly as humanly as I can, and then translate what it actually means and take out the key information? Those are pattern recognitions, right? So the more you do it, the better you're gonna get. Simple as that. All right, let me pause for a bit. Let me get a quick drink. All right, Mohammed, I'm glad to be part of this webinar. I'm glad to. Try all quick money. Like signals, copy trading, nothing plays out. Self-knowledge is power. Weekly market review helps out a lot. Thank you. That's how you actually calculate potential risk. Yes, we will talk about risk calculation, risk management, I believe, after trading psychology. I think it's going to be next week. But yeah, I think it's going to be next week or 2 weeks after. But I think next week it's going to be. We're still going to do this next week, and then I'm going to take a week off. But yeah. All right. Is it advisable to take swing trade on a Friday when the market is going to close for the week, or wait for a new week? Really depends, Dayo. Very rare for me to actually initiate a new trade on Friday, just because. How do I know? Good. That's a really good question. Let me give you an example on how to actually understand my way of trading. All right. Basically, after reviewing my trades, what went right, what went wrong, I came to the conclusion that with how I actually trade, I don't do well on Mondays. I don't do well on Fridays. Not that it's going to be bad all the time, but the probability is actually more than 50% that I do bad trades on Monday and Friday. All right, so create your own routine. My routine is that on Monday and Friday, I actually stay away from the market. Unless there's a really, really good opportunity, I don't initiate a trade on a Monday and on a Fridays. But it really depends. I can't be the judge to tell you, yeah, don't do it on Fridays. I can give you the logic behind it. Let me give you the logic if you want to hear me out. On Monday, the US market, the market starts with the Asian session, and then it goes into the European session, and then the American session starts, right? Typically, Asian session will react to whatever happened on Friday on the US session. They'll follow through, and on Monday evening, things could change because the US market is open, and then it will revert. So it might do something different from the Asian market, and then on Tuesday morning when Asia wakes up, they'll get that information from the US session and then trade according to what happens in the US, right? Don't you guys notice that pattern? So Monday, sometimes it flip-flops, and that's the reason why I stay away on Monday until at least the European market opens. Okay, typically I avoid the Asian session. That's why I can have my time to do my weekly review for you guys, because I stay away from the Asian sessions. I don't really care what happens during the Asian sessions. So that's the time for me to actually look at what happened last week, what's likely going to happen this week. So Monday is always a time for me to reflect on what's been going on last week. What happened? What happened to that CPI number? What happened to the FOMC meeting minutes and stuff like that, right? And now I'll use that information that I get from last week, and then I'll compare it to what could potentially happen this week to prepare myself. So Monday is always a day of reflection. I'll start trading on Tuesday, Wednesday, and Thursday. And on Friday, I will try not to trade I will try not to trade when the Asian session closes, right? Post Asian session, the European market is open, but once the Asian session closes, and then the European market just go by itself, I typically avoid trades on a Friday for that one particular reason. We basically have what we saw this week. We have a lack of liquidity. We have exaggerated volatility, and then all of a sudden it goes flat. It doesn't have that volatility or that drive again. So on a Friday, because it's a Friday. Come on, guys, all right? It's a Friday. People, for you guys to actually come into my webinar on Fridays, I'm actually super happy, because a lot of people, it's day off for them, right? Friday ends, it's the weekend, they start partying on Friday, or they start relaxing, unwinding on Fridays. So we have a decreased number of market participants on Friday. Because of that, the market will lack liquidity. In terms of volatility, it's not going to be normal either, and that's the reason why I avoided Fridays. Simple. All right, so you guys know my logic on why I avoid Mondays and why I avoid Fridays. But that's just me. Okay. All right. So yeah, again, successful traders does not view the market. They are successful because they review the market for patterns, and they basically learn how to exploit these opportunities in the market as soon as possible. Few questions that can be a guideline for you is that you need to ask yourself what happened. All right, what went right? What went wrong? How do you actually going to be performing better in the future? What needs to be changed, right? Train pattern recognition, and then preemptively anticipate market movement. So the more patterns you look at, the more your brain is just going to click as soon as possible. So if the trade went right, what was the reason why you take that trade, right? If it's a specific technical patterns, jot down that technical patterns. You need to review that pattern. For example, if I see a dark cloud cover on the candlestick in an uptrend, I do know that has a higher probability of indicating a potential reversal. If I see a bullish engulfing, a bearish engulfing, I typically ignore those because they're so simple. And people just assume that, oh yeah, you know what, because it engulfs the previous candle, it is a much stronger signal and stuff like that. And in reality, it's not like that. But you're not going to be able to figure this out if you don't review your trades, right? So you need to review your trades. Was there a technical patterns that happened, and what happened? Was there news that impacted the market? So you need to review this. And I already mentioned this. Successful athletes actually spend more time practicing than performing. All right, they practice a lot for a competition, building muscles by going to the gym as often as possible. And they, you can go to the gym. You can go to the gym every day, all right, and spend 2 hours in there. But if you don't know what you're doing, your muscle wouldn't grow, because comparing to just staying in the gym for 2 hours and you're doing it wrong, you're not going to grow your muscles. If someone can actually go to the gym and just work out for 30 minutes and they actually build faster, stronger, bigger muscles, right, in a shorter period of time, and that's being efficient. So yeah, look, I think there's a World Cup going on right now. I don't follow soccer, but is it still on, the World Cup? If you take a look at the World Cup, right? I believe it happens every 4 years, right? And it's a huge thing. But to get to the World Cup, to play you play in the World Cup, what kind of training do you have to go through? Maybe soccer matches happen once or twice a month, right? But soccer players basically go to training every day, right? Even though there's nothing there for them, they just can't get lazy. They just need to keep practicing. Same thing as a pianist, for example. You play your piano every day. Maybe you do a recital or a concert once a year, right? Maybe they go for that. Okay, so this pattern recognition and stuff like that, if I can put it simply, it's basically like muscles. The only way to improve your trading is through super boring repetition, and that's fact. Okay, so I'm not gonna sugarcoat it. I'm not gonna say like, yeah, you know what, trading is so, I'm a trader. I'm so fancy. I use this technique. I came up with names on this technique, and it's doing awesome. And then I try to sell it to other people. I don't do that, right? Don't you guys notice that? I try to keep it as simple as possible. I don't really do anything. I don't really take on to new strategies because I'm probably old school. So I stick to the old ways in trading. But yeah, as I say, it doesn't matter what you want to be trading, right? You can invent your own techniques if you want to, and that's completely fine. You may be able to figure something out, but to be able to get there, you need to get your basics right, and you need to get your basics strong. As simple as that. So it's really boring repetition, and unfortunately, if you think trading is not boring, it's actually good to be boring when it comes to trading. If you are successful in using as little tools as possible, or keeping your strategies to just maybe one or two strategies to deal with the market, that's really trimming it. That's making it lean, right? You're actually going to perform better than the other trader that probably know about 1,000 strategy in the market, but can't really master any of them. NFP is on Friday. I'm not talking about NFP. I was talking about the FOMC meeting minutes. It's not the NFP. NFP is next week on Friday. All right. Let me go through. I need buy trade only when the price is above cloud and sell when the price is trading below cloud, but sometimes I find the price trading above cloud in 1 hour and below the cloud in 4 hour. Mohammed Baba, we talked about this on the multiple time frame analysis. I think it was just 2 weeks ago or 3. But typically we don't overlap the 4 hourly and the hourly time frame, so they are likely going to give you mixed signals. So really choose one. If you were asking, let me just answer that while it's there. Okay, so you guys get this, right? Nothing fancy is required when it comes to trading. All you need to do is understand the basics, keep repeating the basics, and keep practicing. That's basically it. Let me give you an example. If you don't want to trade today, I don't feel like trading today, doesn't matter. Take a look at the chart, okay, and then analyze it, figure out where it's likely going to go. That's what the demo account is for. The demo account is not there for you to think that you can do good and then you do real trades and it's all different. The demo account is actually there for you to practice. It's called a practice account for a reason, because at times when you're not sure yet what you're supposed to be doing, that's where the demo account comes in, and that's when you practice. All right, that's where you look for these patterns. That's where you have that luxury to simulate what's likely going to happen, right? Practice there if you want to, or you can do it on real account. I much prefer to do it on real account because to me, 1 cent, it's still real money compared compared to a demo account, because trading too long in the demo account, it's basically just going to ruin your trading psychology. You are bound to have a different view of the market. Okay, we good on this one here? All right. So, so most traders are focused just on trading during development phase. They actually ignore trading for pattern recognition, and this is what I just said about the demo account. It's actually there for a very particular good reason. It's not there to entice you to know what the market is. It's not. It is actually a tool that a trader can actually tap into and practice, right? Right. Again, pattern recognition is not just market patterns, but also the patterns on how you actually behave and react during a trade. So if we ask the question, what went wrong, how it happened, blah, 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 we haven't even touched on what were you feeling when you take that trade, during the trade, after the trade, right? How do you actually behave? How do you actually react? If you don't have it planned out, you don't know the risk, you're probably going to react like you're going crazy. If you know what the risk is, then you're probably just going to chill and say, I already know, that's my risk, okay? So very, very simple stuff, simple things like this. It's actually going to affect how you actually trade. All right, let's talk about Trading Journal, because if you do know what Trading Journal is, say yes, I do know what Trading Journal is. If this is the first time you ever heard about Trading Journal, type in first. So I want to know how many people actually know what a Trading Journal is. So Trading Journal is actually something that you keep to yourself to make you be responsible to your own trading. Again, Trading Journal is something that I keep every week. I'll do this every single time I trade, and every week or every month I'll review those trades. And how do I review my trades? It's by going through my Trading Journal, right? Wilvin say yes. I would assume you would say yes. Okay, Dayo says yes, I know what a Trading Journal is, but do you use the Trading Journal, right? But for those that don't know what a Trading Journal is, it's basically just a record of the time you trade, the reason you trade, and what you were trading. This is basically what shapes you. There are patterns here that's actually going to shape you as a trader, right? I did briefly mention on why I avoid Monday and Fridays. How do I know I do bad on Mondays and Friday? Because I review my Trading Journal. I know when I traded, and it's always the Monday and the Fridays that causes me a lot of losses, right? So and then the next month I tried to cut Mondays, and then it improves. The number of losing trades went down, so I cut Friday. So if I trim Monday and Friday, I improve a lot of my trading. So look, on top of that, I get a bonus Monday and Friday off, right? Simple as that. But Trading Journal makes you be responsible for what you're actually aiming for, your goals, right? And also the results of your trading. Okay. So review those trade journals to find out your good and bad habits when it comes to trading. I can talk more a little bit about this right now. The hours and the days suitable for trading. I'm not good on Monday. I'm not good on Friday. I don't do well during the Asian session. I do very well on the European and UK session. I'm doing okay on the US session. So that way I can focus on just trading on the European session. But that's basically how it is. Because, I look at pound USD. Obviously, I'll probably do better on the European session, but what kind of instruments are actually suitable for your trading style? Every week I do 2 market outlooks, live market outlooks, and every week, I get people asking me weird stuff. People who are trading Euro AUD, Euro CAD. This are not reserved for beginners. I think that people are just jumping through a lot of charts and trying to apply a lot of what they think the market should be doing. it doesn't work that way, because you really need to know what instruments you are trading, what time you should be trading those instruments, and this, you are only going to be able to pick this up using a trading journal. Because apart from Monday and Fridays, I would also like to disclose something to you. I don't do very well in AUD USD. Okay, not that I don't know what's likely going to happen. It's just that the Aussie USD moves differently compared to the Pound USD or the Euro USD. The Aussie USD is typically more of a range-bound market condition. My strategy when it comes to trading is suitable more on a trending market, right? So I tried to apply it, and with the Aussie USD, I get, the hits and misses. It's still about 50%, but I get about 30-40% of losses in there. It's just not worth it to continue looking at the Aussie USD for me, because comparing it to how I trade on the Pound USD, it's so different, right? It's just not worth my time. So see what I'm trying to do here? I'm actually trimming the fat. I'm actually trimming a lot of the stuff that's not suitable for me, or stuff that I'm not doing well. Cut it off and see what happens, right? And that's basically how you shape your patterns. Okay, so I think I just saw someone type in a checklist, but I'll look at that in a minute. But for beginners, a trading journal, it's actually a benchmark for your individual trading styles. It's how you compare your trading, not to other people, but to your previous self, right? Do you see an improvement? This is your trading journal. This is basically your benchmark. This is how you compare stuff, right? Am I doing better, or am I actually doing worse? How you do that is by comparing trading journal this month and the previous month, or this week and the previous week. But you need some sort of a comparison, and your benchmark is going to be a trading journal. I want to know, not use, right? So yeah, a lot of people know what trading journal is, but implementing it to their trading, it's actually, maybe I would say 4 out of 10 people will keep a trading journal once they learn how to do it. The rest would probably just do it for a week or two, and then they say, yeah, forget it, I'm just too lazy to write it down. So we'll then say it's like my checklist, and then review it on the weekend. Yep, pretty much. Yeah. Any specific format of journal you can share? There are actually a few, so I'm actually going to go through this now. Is it better to focus on specific pairs? Yes. I'll show you a little bit on my trade here. This was a trade done last year, so I'll show it. That's completely fine. But is it better to focus on specific pairs? You'll actually be surprised on how many pairs I actually trade. Second on Friday, the market teach on weekly high low in this market big kind. What? I have no idea what's being written. The second on Friday, the market teach on weekly high low. In this regard, market make big candle, be facing many losses. What pairs do you suggest for beginners? What pairs I suggest for beginners? Try the Euro USD. That's number one. You can take a look at the dollar yen. That's number two. And then move on to the Pound USD and the Aussie USD. Because the Pound USD, the reason why I don't put Pound USD number one, because in terms of range, the Pound USD is actually out of the major currencies, it has the biggest range in a day, right? It's in terms of volatility, it actually is. Totally agree with the Euro Pound and AUD. Yeah, I get different results there too using similar strategy. Took the AUD last month, worked better so far, right? See, Tian, you know what I'm talking about, right? Because I apply the same strategy on the Aussie USD, it just doesn't work. So it's not that one strategy will always work. It's not. That's the reason why I say I can teach you something, but how you do that, how you replicate that, it's going to be tough, because we talk a lot. I mean, we talk about different indicators. We talk about Ichimoku patterns. We talk about candlestick patterns. Why we talk about I think we did talk about this, right? Identifying market trends and stuff like that. Sometimes we look at a higher high, higher low in the market. We look at divergence. Are all this applicable the same way in every single currency? No. It's not like that. So you need to understand this yourself. You need to figure out what you want to be trading. How to know the best pairs and the best time for trading? I just mentioned this. It's your trading journal. You need to do. It's always going to be a trial and error, right? You need to jump in to know what's best for you. So if you're a beginner, you can actually do this on a demo account first if you want to. Just trade on different. Pick up one strategy and then apply it on a few currencies, and then you should be able to pick up, what's suitable for you. All right. How to know the best pairs and the best time for trading? There's actually I don't actually think we talk about this, but there's I'll get it. I think we should be doing this in the future, but there are specific times when the market is actually active or not. I think we did talk about this on the first week when we talk about volatility in the market. Anyway, it's as simple as this. When the market is open, what currency is that market open for? For example, the Aussie USD. You normally trade this when the Aussie market is open, right? You trade the sterling pairs when the UK market is open. That's kind of simple logic. So you actually don't need to think too hard for this one. All right, if I trade the Aussie USD, so I can trade the Aussie in the morning during the Australian market open, or I can trade this at night when the US market is open. I don't know, for whatever reason, a lot of Americans like to trade the Aussie USD. So it does move during the US session as well. Okay. Right. So just a few examples. This is actually submitted. This is not mine. This is actually submitted to me. It's one of OctaFX client. We did this about, I believe this was done 2 years ago. So sorry, it was last year, January 2021. So it was, it will be 2 years, right? Because in 1 month time, it is going to be 2 years. So yeah, this was actually in January 2021. So someone submitted this. This is part of the trading journal, right? So you can actually take a screenshot right now. It's easy right now. I do keep my trading journal really as in a journal, but you can do this. You can screenshot it. You can save it on your tablet and your computer and stuff like that. But just write down, because this was submitted and someone say the reason why they trade was because there was a 61.8% as a resistance in the market on the Aussie USD. So that's the reason. But this is a little bit messy, right? So they can short it, and then this is the reason why they get in. This is where they want to get out. They got a target price. There's a risk to reward ratio, 2% risk, reward is 4%, so 1 to 2 risk reward ratio, right? So this could be part of your trading journal. You can do this way. That's completely fine, or you can write down in a book. But what you need to know, it's let me go back here. All you need to do is just write down the time when you trade, what day, the reason why you opened that trade, and also when you close that trade, what happened? Did it hit your target? Did you get stopped out, or did you close it manually? And if you close it manually, what was the reason why you actually closed that trade, right? So it's just as simple as that. So I think there was a question, what should I get from my trading journal? Number one is obviously time. When you trade it, what you trade, why you trade, why you close your position, why is your position closed? Was it because it hits your target, or was it because you got stopped out? or if you close it manually, what happened, and give a reason why you actually manually close it. You can write down, NFP numbers coming out soon. I don't like that risk. I want to close out early. That's completely fine. Just write down a reason, whatever reason that you want to, right? This journal is private, obviously, so keep it to yourself. All the time insight market signals given by OctaFX goes opposite to what has been told. I don't do signals. I don't write those signals, so I don't know what it is. How is it going to be applicable? So let me just touch base a little bit on this one here. I think Mudassar mentioned this. He went through signal services. He went through stuff, but at the end of the day, you do need to understand what's good for you, right? A signal could be good for someone that trades in a very specific time frame. It might not be suitable for you, obviously, number one. But yeah, look, it's not, as I said, trading is going to be unique, right? You're not going to be, it's really hard for you to be a copy of some other trader, right? So let me talk a little bit about this. I'm not saying that copy trading doesn't work, but copy trading does work, but you need to know who you are copying and whether that person that you copy has a very similar strategy to yourself, a very similar risk profile that you have. You need to understand that kind of stuff, right? All right, anyway, moving on. Right, so you can do trading journals like this. Doesn't matter, you can do that. Or this is I think this is me. This is just an example, but I use this with my Ichimoku. All right, I can look at that and say, yeah, it's very thin Kumo. It's very easy to break resistance. Stochastic is above 80, so that means market could actually trend up, and that's basically what I look at the market for. There's going to be resistance at 78.6%. Yeah, take a snapshot, whatever. Just keep it as a record, so you actually know when you want to review it why you actually jump in on a very specific trade. All right. Right, so I can say price is within an uptrend. We got a little bit of a normal retracement at 38.2%. Then I can just jump in again. So to do this, I think this is the easiest method. Just take a screenshot of what you're looking at. Type in some notes or stuff like that on it, and then you can come back and review it. I think this is the easiest way to do it right now. Back in the old days, we don't really have this kind of access to it, so we still review stuff manually. We create our own tables. If you want it easy, you want to do your calculations later, you want to have charts on it, just use a spreadsheet, right? Use Excel or numbers, depending on whether you are a Mac OS or Windows user, or Google Sheets, free, right? Just type it in, put it into a spreadsheet, and then you can actually analyze your results later on. Okay, so let me just give you a few on some of my trades here. If you take a look at what happened here, it's basically just in January 2021. You take a look at what I trade, right? It's basically sterling yen, pound USD, pound USD, pound USD, pound USD, sterling yen, sterling yen, sterling yen, sterling yen, pound USD. Notice that? So I put a lot of my effort into the sterlings, a lot, all right? And I don't need to be trading 10 different currencies to find opportunities in the market. I don't need to. All I need to do is just jump in on very specific currencies and know the specific currencies really, really well. That's how you're actually going to be performing better, right? You don't need to look at 10 different stuff, 4 different stuff. You can focus on 1 or 2, but this is easy for me because I know what I'm doing. So I already know my strategy works really well on sterlings. So I trade sterling yen, pound USD, and that's pretty much it. All right. So we are over time, but anyway, let's talk a little bit about the learning environment. And I like this this phrase, H1 teach one, right? Everyone basically is able to teach another person. It's as simple as that. If I can share some of that information to you, you guys can share it to other people. And then, one day, like last week, I think I missed out on something, and someone actually pointed out something on the webinar on Monday, right? So, each one teach one, right? That's basically it. I think when it comes to trading, you actually need to have that community, that openness. You really need to talk about it, because this is trading psychology. This affects you mentally, right? This is going to affect how you look at the market. This is going to affect what the market does to you. Okay, so if you're new, learn the basics. All right, you can do case-based learnings. So case-based learnings means like what I just told you about my Mondays and my Fridays. You can look at a specific case you want to focus on, for example, what day you should be trading, right? You can do that. You can learn in groups. This is really good. It's just that a lot of people abuse it, right? And actually I'll reply to it. The thing is, with the community right now, it's really, really tough, especially in a trading environment, right? You set up a Telegram group, and all of a sudden you get spam. And all of a sudden people are just trying to scam other people. So the community, it's used for a negative purpose. It's not used to actually learning groups. So I don't know if joining a group like a Reddit channel or stuff like that is actually going to do you good. Maybe you'll get some good comments, but I think there's a lot more negativity in those public forums, I guess. So yeah, maybe if you can do I know it's COVID and all, but if you can do a local group with local traders that you share that information. I don't know, maybe you can start sharing how to actually look at the market. So learning in groups, it's a proven strategy. Comparing it to learning in stuff by yourself, it's actually easy to learn in groups. The thing is, groups right now, I look at stuff that's being written on the Telegram channel. I don't know. I really don't know, right? I think there's an opportunity for a lot of people to actually misuse this opportunity, but yeah, learning in groups is actually going to be really, really good, especially if you're a beginner. The thing is, with a beginner, you need to be careful what other people are saying to you, because they could be saying the wrong stuff to you, right? They could really be out there scamming you. I don't know. Maybe just be smart when it comes to learning in groups. Was there a lag? No? Okay. Right. That's for newbies, right? That's a problem, because new traders goes into a group with the intention to learn, and then most of the time either they get scammed or they get confused. They're not really learning. People only talk about what they earn, how good they are. They never talk about what their problems are. They never share that problem. That's the kind of stuff, or the difficulty when it comes to learning in groups. But if you can filter this out, learning in groups is actually really good. Joining a community, it's really good. It's just whether or not that community it's good for you. That's the thing you need to decide for yourself, right? And then you have the competency stage. This is where we do shadowing or assisting professional traders. If you have the opportunity to do that, if you have the opportunity to observe a professional trader or a trader, then you can actually improve your trading, because you'll get a little bit of an insight into what they're doing. Okay, so I guess my Monday session and Wednesday session is actually a shadowing session, because you actually take a look at how I actually look at the market, right? You can actually use this as a tool to help you improve, right? And then when it goes to expertise, there's that growing complexity of analyzing the market. For example, on my Outlook sessions, I get requested to look at the daily time frame, and I need to give a response for that daily time frame outlook. And someone's gonna ask about the same thing, but on the hourly time frame. There's always that growing complexity of analyzing the market. What I'm telling you right now here is that as you become an expert, remember how I told you start with the basics, right? This is when you can actually start adding stuff into your trading and see if it works for you or not. Okay, you are also going to grow your risk tolerance in the market. Okay, so that's the expertise stage. Now these are the 3 stages that we talked about last week. Okay, let me go through the chat. Can I advise what technique is effective for US30? Depends on how you look at the US30. Do you look at it as a reference point, or do you actually trade the index? If you're trading the index, do you want to trade it in the short term, long term, and stuff like that? See, it goes back to you. What do you want to do with it? And then we can mix and match a few strategies. But what kind of strategies really depends. I've outlaid a lot of strategies, a lot of techniques. Which one do you like most? That's basically it. Oh, so yeah, there's a reply. This is a tool for market analysis that may be used to develop a trading strategy. Yes, and comprehend broad market movement. Yes, completely agree. And there's no 100% accuracy. That's completely, I completely agree with that. So when it comes to trading, if someone like this groups, like right, the negative in groups, if someone say, I follow this guy, or use this strategy, I can sell you a strategy, guaranteed returns. That word guaranteed returns are bullshit, right? It's not gonna happen. There's never 100% guarantee in life. So I think I mentioned this last week. No matter how positive I am, I always have 0.1% of being unsure, right? So no matter how no matter how positive I am, I always have something negative that could be, that could turn things around. Right? I will never say anything is 100%, because to me, everything is always a 99%. There's always a 0.1% or 1% possibility that things could actually go wrong. All right, that's how we actually need to look at the market. So if you assume that trading is 100% guarantee and stuff like that, yeah, this is not for you. You need to move on, or you need to understand that there's no such thing as 100% guarantee. All right, we clear on this one? All right, so the best learning environment is that you need to connect with other traders. How you want to connect, how to get there, it really depends on your situations, right? It's always good to be able to learn together in a trading community. So maybe if you pick out friends in a trading channel, for example, or forums, then maybe create your own community. Then I think that's great. And the reason why learning in groups is best, because can actually point out each other's mistake and actually grow together. And the problem with improving yourself as a trader is that no one is there to tell you you're doing things wrong. All right, and obviously I can't say that. I can see how many people are watching this right now, but how many people are watching this in the future. Obviously I can't say you're right or wrong, so you need other people to actually tell you whether you're doing it right or wrong, or maybe figure it out together. Okay, so let me give you an example. In trading firms, we basically, traders basically need to work with an analyst. So analysts will lay out the plan, and then traders will point out what is actually missing in the plan and execute that trade and manage the trade. So if someone tells you, hey, I'm a trader, blah, 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 for the big banks and stuff like that, typically they have an analyst that's going to assist them. This is the potential, right? How do you actually want to use this information? That's the trader's job. But in terms of planning and stuff like that, the analysts will do that, and the traders basically their role is basically just to execute that trade and manage that trade. Simple as that. So it's split out. in terms of responsibility. Okay. All right. The other thing for beginners, I think most traders will actually fail because they take too much risk too soon. Look, we are over time, I know, but let me go through this. Shouldn't be long, right? Just a few more slides, bear with me. So most traders will actually fail because they take too much risk too soon. Okay, so they could, what I'm trying to say with this here is maybe you start with $100 and you're actually trading a standard lot size or a mini lot size. You know, with $100, maybe you should be trading a micro lot size first. But the reason why traders do this is that they think with a small capital, they can earn really quickly. Not saying it's impossible, it's just a high risk thing, right? If they take on too much risk too soon, it's actually going to damage how they actually view the market. Okay, I think speaking out of experience, all of us has experienced this. But yeah, so let's talk a little bit about psychology of risk management. It's basically risk, the psychology behind risk management. I think we are going to be talking about risk management next week or then the week after, but the psychology behind that is actually just for you to be able to build confidence when it comes to trading, right? So the reason why we have risk management is actually to build confidence in the market, right? So to develop, there must be a sense of competence. So you will need to build your confidence in trading by being in control and being competent in trading that. So this could help you avoid blowups that causes trauma. Okay. So again, when we talk about leverage, it's always huge win, huge losses, small wins, small losses, right? So you need to adjust risk tolerance accordingly to your experience and capital. If you have a smaller capital, don't trade large amounts of lot size, right? Don't do that. So trade accordingly. You need to adjust your equity accordingly. We will talk about this in money management and risk management, but just to bring it up a little bit, the reason why we actually want to take a look at risk management, because risk management, it's definitely still part of trading psychology anyway. So the other thing is never losing big can actually cause this problem as well. So if you're trading and if your losses it's let's say limited to $10, $100, right? The moment you hit 1,000 as your loss in one trade, it will actually destroy your sense of being competent in trading, and it will also destroy your confidence as well. So point is, if you guys get margin call, it's actually pretty normal. It's actually a pretty good experience, right? So because I can teach you stuff about trading psychology, but it will not register in your brain unless you suffer huge losses. So those that suffer huge losses should be able to pick up what I'm trying to say tonight. It'll probably make a lot more sense to you, right? Because beginner traders that never experience huge losses or never experience a lot of losses, they get overconfident. They start going crazy with their lot sizes because they think they're invincible. And that's where one big losses can actually kind of brings down everything, right? If you get into a stuff like a huge loss that causes psychological trauma in your trading, that's pretty much it, because the recovery process is actually a little bit harder, and we actually do have a webinar on that one as well. Okay, so how to normalize this failure? So we don't want huge blowups, right? So number one, it's plan your losses, obviously. So that's why we say, look at the potential risk, the potential losses, know how much risk you're taking. So with this process will actually develop your risk tolerance and normalize your failure losses, because before you open the position, you know what are your potential losses, and if you're willing to accept that, that's an improvement on your risk tolerance and also accepting your failures, right? And this is a few tips from myself, right? Apply this if you think it makes sense. But I expect every trade that I take will fail. I don't hope, okay? I think we mentioned this last week, right? I hate the word hope because once we start hoping, we have a problem. So every trade that I take, I will assume that I will fail, right? So that way I don't have any high expectations. In fact, I don't have any expectations at all, right? Because I assume that with the risk involved, my trade, I would just assume that my trade will fail. Okay, once that trade's running, it's really out of my hand. It's out of my control. You can take this tip if you want to, if it makes sense a little bit. But I know this is a strong word by saying that it will fail. The reason why I drilled that into myself as a trader is that if I say that, I really don't have any high expectations. I really don't hope for anything, right? That's psychologically conditioning myself to accept that the loss is there. Because the problem with trading and the whole trading psychology is that people don't accept their losses. That's the problem. It's as simple as not being able to accept any losses in a market that causes a lot of problems. So to me, I psychologically condition myself to accept the losses all the time. So I know the risk, and then I look at the risk. Do I want to take the risk? When I say I want to take the risk, then I know how much I'm risking, what's on the table for me. Even though I have a good probability, even though I have a good risk-to-reward ratio, there's always risk involved, especially when it comes to trading and investing. Look, there's risk involved every day, right? There is risk involved in you guys watching this right now. Maybe your phone overheats. If you're watching on a phone, maybe your phone overheats and then maybe the battery is going to explode. I don't know, right? Maybe there's always going to be risk, right? When you eat, there's always the potential risk. I don't know. People die from choking, I guess. So could it be that there's a risk involved in eating quickly, too fast? You could choke, yes. Could you die? Maybe. I don't know. Don't even want to talk about that. But yeah, life is full of risks. I think the idea of understanding and accepting that risk is being part of being alive. I think that's probably something that we can actually apply to trading. So even though I have a higher probability in my analysis, in my trades, and I know I have that because I have a trading journal to back that up, but I always assume that every trade will always have a 50-50 probability, and that's the reason why I stick to a 1-to-2 risk-to-reward ratio. We have the logic last week, and the logic with a 50-50 for every coin is that with a 1-to-2 risk-reward ratio, it makes a lot more sense. But with a 1-to-1 risk-reward ratio, sometimes it doesn't make sense, right? So pick and choose. Do you want to expect that the trade taken will fail to avoid having high expectations? Or do you want to assume that each trade will always have a 50-50 probability? Or do you want to be expect to be wrong, don't expect to be right? You can combine all three if you want to, but this slide here, it's really negative, but it's designed for a specific purpose that this is actually designed for you to actually normalize your failures, right? This is designed to be able to accept your failures, right? Because if you do the stuff that's being listed here, when something goes wrong, it's easier for you to accept that losses, right? It's just as simple as that. So for those that just join in, and you're looking at this, you need to understand what I'm trying to say here. But yeah, if you normalize your failures, it's easy for you to accept that, and it's easier for you to actually learn going forward into the future. Okay. So the psychology of risk management, it's to observe, right? You need to look, psychology of risk management, psychology of trading. You basically need to observe it, right? You need to observe the market, obviously. You need to be observed, right? Other people need to observe what you're doing. And obviously, you got to try it out yourself. You can take a look at the market, but you might not be trading. So, you're still learning. That's completely fine. And then you ask people to actually look at how you trade. But yeah, ultimately you need to try it out yourself. So A lot of the questions on what should I trade, when should I trade, those cannot be answered by me. If anyone can give you the answer, it should be yourself, right? Okay. All right, so it's always observing, being observed, and trying it out. Experiment, that's the keyword here, basically that. Okay, so once that's carried out, it's basically just to form a feeling of expertise in risk management or trading psychology. But anyway, you need to do these three when it comes to trading. All right, Q&A session. Okay. Shall we be having Ishimoku part 3? I don't think we have that scheduled in this series. I just double checked, but Ichimoku part 3 is not in the series. It might be in additional webinars once we're done with the series. How to get assisting professional traders. Is there a special class or group discussion to learn about trading? Look, you guys have the OctaFX trading Telegram channel, right? But let me just warn you there. I actually view it as well, and it's not just any specific Telegram channel or anything like that, but pretty much anything. I think right now, you need to understand that there are a lot of scammers out there, so you just need to watch out for yourself. But yeah, is there any special class or group discussion? You need to find that out by yourself, right? I don't run a group discussion. The Telegram channel that I run is basically just something that I posted updates on the market and stuff like that, and any fundamental impacts in the market, stuff like that gets updated. Any technical updates get updated there, but I don't lead a special discussion group. So yeah, I mean, if you guys maybe Team Octa can point the right figure to the right direction on this one here. But yeah, look, even right now, you guys can ask each other, right? Where you guys from, and maybe set up a channel, a group, get involved, because it's ideal if you do it with people that you know. I think that would be best, yeah. So Prince Davidson just joined in when I'm being super negative on the last two slides. So that's why I gave that warning out. How many percent maximum per trade if our risk to reward ratio is 1 to 2%? It really depends. It really depends on your risk tolerance. I actually have a very, very specific rules. Short-term trades, I typically do a max of 10%, but let me give you an explanation on this one here. If you put your risk at 10%, if your drawdown is actually at 10%, if you lose at 10%, to gain back to 100%, you actually need to do 110% to get back to where you were. So you need to be very, very careful with this one here. If you're doing it great, that's completely fine. To me, if I do a swing trade, I typically don't exceed 3 to 5%. I typically have my trade limited at 5% of my equity, and that's the totality of my trades. So it doesn't matter what risk reward ratio is. It doesn't matter. We'll talk more about this during the money management side of things, but it's more about equity. Risk to reward ratio is part of how you manage your funds, right? But with trading, the goal is basically to grow your equity. It's not about whether you win or lose, right? If you really want to grow as a trader, you want to grow your equity, right? But a lot of people don't understand this because a lot of people would assume, if I started with 1,000, if I can bring it up to 100, I will withdraw my 1,000, and then you'll just be in. So I'll withdraw my 100. I'll keep my 1,000, and then you just be in that loop. You cannot open a position size that's going to be larger because your equity doesn't grow. But if you let it grow, if you let your equity grow from 1,000 to 2,000, you actually have a lot more room to navigate in when it comes to trading. All dollar pairs are influenced by USD. Do you suggest I just pick one? Pick 2 or 3 or 4, doesn't matter. If you're new, I would really stick to the majors. I know when we talk about the majors, the dollar CAD is there, the New Zealand USD is there, the dollar Swiss is there. If I were to say, yeah, you know what, take a look at the Aussie USD, Euro USD, Pound USD, or and the dollar yen, right? Maybe the Aussie USD. It's really dependent on whether you want to trade the Aussie USD. I'm an Aussie, so I look at Australian dollar, and that's the reason why I need to still look at Australian dollar, even though I don't really like the Australian dollar, right? But that's me, right? How does spread affect your risk management? Of course, spread is going to affect your risk management. If you're trading on an exotic currency with a spread that's about 3.5, you need to adjust your stop loss or take profit to match that that spread, right? For example, if you take a look at my outlook this week, I specifically say this is holiday season. We could have lower liquidity in the market. We could have higher volatility than expected in the market, or the market will actually go flat. All right, that's basically your cue that you need to factor in the potential spread in the market. Is that trading journal tools for us for controlling and analyzing our trading history? I actually do have a slide on a trading journal, but we do trading journal on a separate webinar. Today is really more of an introduction, more than anything else. But to go in depth on trading journal, we used to run a separate webinar for it, because look, this is 1.5 hours. I tried to keep it to 1 hour. We're still at 1.5 hours. We could be here for 3 hours if we want to talk through about all of this stuff here. But yeah. Trading journal is not really hard. Don't get too complicated about it. You can take a look at some templates online if you want to, but you basically need to know how, when, why. That's simple as that. As long as you have this three, you should be good. Okay. Any other questions? No. All right. If there are no other questions, then we can wrap it up for this week. Thanks for joining in. Have a fantastic weekend ahead, and we'll see you next week. Stay safe.